Welcome to TalkTickers, your deep dive into the latest earnings calls. Today, we're unraveling a truly fascinating market mystery. How did a company like NICE Ltd., ticker NICE, manage to hit strong Q2 2025 earnings beats, showcase an aggressive AI-first strategy, and still see its stock tumble by nearly 14%? That happened on the day of the announcement. We're going to pull back the curtain on the numbers, the strategic plays, and, well, the immediate investor sentiment to try and understand this surprising disconnect. Let's unpack this.
Yeah, it's precisely that puzzling reaction that makes this deep dive so compelling, I think. You have a company seemingly executing its vision confidently, yet the market delivered this swift, quite punitive judgment. So our mission today is really to sift through the data, understand management's narrative, and maybe explore the potential reasons behind this significant gap between performance and perception.
Okay, so to even begin solving this, we need to start with the facts, right? The headline financials themselves. Because on paper, NEC Ltd. delivered a genuinely strong Q2 2025. Their non-GAAP EPS, which, for listeners, that's their adjusted earnings per share, gives a clearer look at core profitability, strips out some one-off items. It came in at $3.01. That actually beat the analyst consensus estimates of $2.99.
Right. And it wasn't just on the profitability front either. Revenue also surged past expectations. It reached approximately $727 million against a consensus of around $713.2 million. So that translates to a solid, 9% to 9.4% year-over-year growth. Pretty healthy. And what's particularly interesting about this revenue picture is its composition. Cloud revenue it continues to be the dominant force. It hit $541 million. That's roughly 74% of their total revenue now. And it grew about 12% year-over-year.
That cloud growth is impressive, yeah. But here's where we see that real strategic pivot coming to life. Their self-service annual recurring revenue, AR, that predictable recurring revenue from their AI stuff. That segment saw an incredible 42% year-over-year jump, 42%, to $238 million. And for anyone wondering how sticky their customers are, their net retention rate, NRR, which tells us how much more existing customers are spending, factoring upgrades and churn, it stayed healthy at around 111%. That's a strong sign of customer loyalty expansion within the base.
And it wasn't just about top-line expansion either. Operational discipline was also evident. Operating income increased a strong 9% year-over-year to $220 million, and that achieved a very respectable 30.2% operating margin, which basically means, for every dollar of revenue, they're converting a healthy 30 cents into profit before taxes and interest. That's a clear indicator of efficient management. So by almost every traditional metric, these numbers look robust, solid.
Okay, so we have undeniable beats on revenue and EPS, strong cloud and AI growth, healthy retention, solid operating margins. Which brings us right back to our central question: why the sharp downturn in the stock? Despite these impressive figures, despite the confident commentary from management, NICE's stock experienced this sharp drop at market open on August 14th, 2025. It ended the day down approximately 13.6%. This dramatic divergence between performance and immediate investor sentiment is really the crux of our deep dive today.
It really is the market equivalent of a paradox, isn't it? The company's saying, look at these fantastic results, and investors are responding with a significant sell-off. To truly understand this, I think we need to dive deeper into the strategic engine NICE is building, because management spent a considerable amount of time highlighting their bold AI-first transformation.
Yeah, indeed. They explicitly stated AI isn't just a feature, it's the heart of our strategy. They're leading an AI-first transformation across the entire customer experience landscape. And this isn't just corporate jargon, right? It's backed by tangible metrics. They reported a sixfold year-over-year increase in Copilot deals. Those are their AI-powered assistant solutions. And like we just noted, that substantial 42% growth in self-service ARR.
And what's particularly illuminating are the specific examples they gave. Just to showcase this AI-driven success, we heard about a major electric utility and a global medical device company. Both chose NICE's CXone mPOWER platform over their existing incumbents. And the key differentiator cited, its unified platform and, crucially, its integrated AI capabilities. Really highlights how integral AI has become in these competitive bake-offs.
And it's not just about winning new logos either. They also shared how a major financial services provider actually added Copilot. They added it to their existing setup after a successful autopilot deployment. So that shows a deepening trust, right? Expansion within their existing client base. It indicates these AI tools are proving their worth in real-world applications, encouraging customers to invest more.
Right. And this aggressive AI commitment is further underscored by a huge strategic move. NICE's plan to acquire Cognigy for approximately $955 million. Big number. The deal's expected to close in Q4 2025. And this isn't just any acquisition. Management framed it as a cornerstone of their AI strategy, specifically designed to significantly advance and accelerate the conversational and agentic AI capabilities within their flagship CXone mPOWER platform. It's a clear signal they're not waiting around. They're actively buying the capabilities they need to lead.
That's a significant investment. Nearly $1 billion just to turbocharge their AI. And it's important for listeners to note, too, that the current guidance excludes any planned impact from this acquisition. It's still subject to regulatory approval. So we're looking at NYSE's performance and projections before Cognigy even fully comes into the picture. The future could look different.
Precisely. And beyond acquisitions, they're also building out a pretty robust ecosystem. NYSE's announced new alliances with industry giants. Think ServiceNow, AWS, Snowflake. These aren't just names. These are critical partners in the enterprise tech landscape.
And it's not just new relationships. They're also deepening existing strategic partnerships, like with Salesforce, and reinvigorating their long-standing relationship with RingCentral. This whole approach is really interesting to me. It sounds like they're trying to solidify their role as a platform integrator, for intelligent CX workflows, removing friction for customers who want all their different tech platforms to talk to each other seamlessly.
That's exactly the strategic intent. Management specifically addressed the perception of overlap, particularly with Salesforce and RingCentral. They stated their focus is on being the leading CX AI platform while coexisting proactively with other enterprise tech providers. It's a nuanced approach, but maybe a mature one, to partnerships in this complex tech ecosystem, acknowledging that, no single vendor can do everything, and customers expect their solutions to play nicely together.
I think that's a shrewd move in today's interconnected enterprise.
Definitely.
Companies aren't looking for fragmented solutions anymore. They want that unified platform that talks to everything else they use. And speaking of expansion, another area showing significant strength that management highlighted was their international growth and sovereign cloud traction, too.
Absolutely. The company is experiencing what they termed significant and accelerating growth potential in international markets.
Yeah.
This surge seems driven by two key factors. One, rising global demand for comprehensive AI platforms, and two, strong traction with their sovereign cloud deployments, especially in privacy-conscious countries like Germany and France. Sovereign clouds are critical for governments, highly regulated industries, places that need data to stay within specific national borders.
And they shared some really impressive international wins that underscore this global momentum. There was a landmark agreement worth over $100 million with the UK Department of Work and Pensions, a deal that apparently displaced two incumbent competitors. That's big. And AOK Plus, a major German health insurer, also chose CXone mPOWER over an incumbent, explicitly citing NYSE's unified platform and sovereign cloud capabilities as key reasons.
Yeah, and another notable win was a UK-based insurance company. Signed a significant seven-figure deal and displaced 3 legacy vendors in the process. These examples aren't just numbers. They really demonstrate NYSE's ability to compete and win against established players in diverse international markets. And it seems driven by their AI and cloud capabilities.
Okay, so despite all this growth, all this strategic investment, operational discipline seems to remain a core focus. They did report a slight decline in total gross margin, down to 69.3% from 70.7% last year, which they primarily attributed to increased cloud infrastructure investments, especially for supporting that rapid international expansion we just discussed. But it's noteworthy that operating income and the overall operating margin remain strong.
Right. And management was clear they're maintaining disciplined operational rigor. They're projecting a 50 basis point year-over-year increase in non-GAAP operating margin for the full year 2025. For listeners, 50 basis points, that's simply half a percentage point, a clear sign of financial management even amidst heavy investment. Cash flow from operations was $61 million. That was a decrease, but attributed to a non-recurring tax expense and the timing of some large customer collections that shifted just past quarter end. So it suggests it's more of a timing issue than a fundamental problem, hopefully.
And crucially, their balance sheet looks robust. NYSE boasts $1.2 billion in net cash and investments. This financial strength provides ample flexibility, right, to support organic investment, strategic acquisitions like Cognigy, and ongoing share repurchases. It means they have the firepower to execute these ambitious plans.
Now, it wasn't all positive news, and management was, to their credit, transparent about some headwinds. They openly discussed some softness in their LiveVox business. That's their outbound engagement platform. This underperformance was attributed to higher than anticipated customer churn.
That's a key detail, isn't it? It wasn't necessarily about losing to competitors. Management indicated some organizations are choosing to develop these outbound capabilities in-house, rather than switching to an external vendor like LiveVox. Now, while they admitted LiveVox is creating a weight on overall cloud growth, causing some, near-term jitters, management reiterated full confidence in achieving their overall 12% year-over-year cloud revenue growth target for the full year.
Yeah, they seem to view LiveVox as a long-term strategic asset for outbound capabilities, believing its current challenges are more of a short-term blip, maybe due to some temporary market experimentation with internal builds. It's a fascinating challenge when your customers decide to insource rather than outsource a service you provide.
And looking ahead, their forward guidance seems to reaffirm their confidence in the overall business trajectory. For Q3 2025, non-GAAP revenue guidance is set at $732 million. That targets about 5% year-over-year growth. Non-GAAP EPS guidance is $3.22, or roughly 10% year-over-year growth at the midpoint.
And for the full year 2025, non-GAAP revenue guidance was reaffirmed. $2,938 million, representing about 7% year-over-year growth. But here's a really crucial data point, one that truly stands out, I think. Full-year non-GAAP EPS guidance was actually raised to $12.53, projecting approximately 12% year-over-year growth. And full-year cloud revenue growth reaffirmed at 12%, operating margins still expected to increase by 50 basis points.
Okay, so let's bring it all back to our central mystery then. We have all these strong numbers: revenue beats, EPS beats, a raised full-year EPS guidance, a clear AI-first strategy, major acquisitions, global wins, disciplined operations. So what explains the market's seemingly irrational reaction, that sharp 13.6% stock drop?
This truly is the core conundrum, isn't it? The immediate market reaction suggests a significant degree of investor skepticism. It's potentially around a few key areas. First, maybe the immediate impact on margins from those increased cloud investments, particularly for international expansion. Investors might just be worried about the short-term drag these investments could have. Second, there could be concerns about the, quote, cost baggage and integration risks associated with that big Cognigy acquisition. Large acquisitions can be tricky to integrate smoothly, and the market often discounts stocks for that uncertainty.
Right. So it sounds like investors are essentially saying, show me the money now, and show me how these big investments will pay off in the immediate future, rather than just taking management's word for it on the long-term vision. They're demanding maybe more immediate proof of returns on capital.
Precisely. It highlights this perceived gap between management's confidence in their long-term AI-driven strategy and the market's focus on potential short-term challenges or dilution. This raises an important question for any long-term investor. Is the market mispricing the fundamental underlying value here? Just focusing too much on these short-term anxieties. I mean, IT operates as a leader in the customer contact as a service, CX, and AI-powered customer experience, CS, markets. It's a rapidly evolving space.
And management specifically noted a significant shift in this market. Large organizations moving to the cloud are now primarily evaluating the AI capabilities of platforms, not just basic cloud functionality. That's a fundamental change from even, 12, 18 months ago? AI seems to have moved from a nice-to-have to a must-have for competitive differentiation.
That's a critical insight. It fundamentally raises the barrier to entry for cloud solutions. And it signals a new era of competitive differentiation based purely on intelligent capabilities.
Yeah.
They also highlighted double-digit growth in interaction volumes brands are receiving. I mean, just think about how much more you're engaging with companies digitally today compared to a few years ago. This surge in volume is precisely what's driving the demand for AI solutions that can handle this scale and facilitate seamless human AI agent interoperability.
So the market might be looking at the costs, but the company is looking at this massive, accelerating demand for what they're building. Interesting tension there. Okay, looking at upcoming catalysts, the anticipated closing of the Cognigy acquisition in Q4 2025 will definitely be a key event. That's when the financial implications will start to come into clearer view, presumably.
And there's more. NYSE plans a capital markets day in October in New York. This is typically where companies provide a deeper look into their future strategy, including midterm financial targets and further developments regarding the Cognigy integration and its expected impact. This could be a pivotal moment for management to bridge that perception gap we talked about and maybe convince the market of their long-term trajectory.
Yeah, it could certainly be a catalyst for a re-rating if management provides convincing details about the integration and its accretive potential, how it will add to future earnings. All right, let's shift gears for a moment into our segment. This is not financial advice, Just a reminder, this segment is for informational and entertainment purposes only. We are not financial advisors. This is not a recommendation to buy or sell any securities. Investing involves risk. Always do your own research. However, we do like to pitch some wild yet plausible trade ideas just to get you thinking.
Okay, well, given the robust underlying business performance we've discussed, especially in AI and cloud, combined with that sharp post-earnings sell-off, a wild yet plausible trade idea could be a long-term bullish reversal play on NACE. The market's immediate reaction just appears, well, overly punitive, potentially pricing in a worst-case scenario for the Cognigy integration or margin impact that management's guidance explicitly works to avoid.
Okay. So the rationale here is that the 13.6% drop implies a significant overreaction from the market, especially considering the beats and the raised EPS guidance. You could argue that the cost baggage or integration risk of Cognigy might already be fully discounted in the stock price, potentially presenting an attractive entry point for those confident in management's ability to execute on that AI-first strategy and find operational leverage.
Exactly. And that upcoming Capital Markets Day in October could provide further clarity. It could act as a catalyst for re-rating. Once more, detailed financial targets for the combined entity are shared, especially if the Cognigy acquisition proves accretive to long-term growth and profitability earlier than some expect. We might see the market aligning more with management's, let's say, cautiously bullish outlook, rather than its initial skepticism. It's essentially a bet on management's execution over the market's immediate jitters.
So we've dissected NICE Ltd's Q2 2025 results. We've revealed a company that, by most measures, seems to be executing well on its AI-first vision, demonstrating strong growth in AI and cloud, strategically expanding through acquisitions and partnerships. Yet, despite these clear strengths, the stock's significant post-earnings dip highlights the market's cautious interpretation, cautious about current investment levels and future integration risks.
Ultimately, the trajectory of NICE's AI-embedded CX orchestration strategy, particularly how successfully they integrate Cognigy and articulate its value. That's going to be the key determinant of future investor confidence. What truly stands out to you about this fascinating disconnect between management's confidence and the market's immediate reaction? It's really a case study in how perceptions, not just pure performance, can drive market movements, isn't it?
Absolutely. Thank you for tuning in to TalkTickers. Remember, this information is for educational purposes only and definitely not financial advice. We appreciate your insights and encourage you to join us for our next deep dive.